Joe's reading the questions for the first time right now.
That's correct. I'm ready.
This is episode 27, and today we are going to discuss if now is a terrible time to buy a used car, when to sell losing stock, and we have 4 topics to touch on in the lightning round at the end of the show. A shortage in cars over the last year is mainly due to supply chain disruptions in the microchip industry. Without microchips, car makers cannot produce new cars that are dependent on the chips to operate their quickly advancing technological features. This has pushed consumers looking to buy a car into the used car market, which has pushed up the prices of used cars because of the increased demand. So for those looking to buy a new car now, do you think they should wait, or do you think they should just go ahead and bite the bullet and pay extra? Drew, what do you think?
It's kind of like the old quote, a rising tide raises all ships. Unfortunately, if you don't have a ship, you're probably underwater. So what I mean by that is it's certainly a terrible time to have to buy a car right now if you don't already have one that you can sell and then use those proceeds to go buy another car. Like homes, it's incredibly expensive to buy a home, but if you already have one, same thing. You just sell it and you get into another home. I think it's a terrible time to buy a car if you can't afford one. I'm a fan of buying cars with cash. I put money into a car fund every month, and then whenever I want to buy a new car, I can only use the cash that I have saved up. Unfortunately, if I wanted to buy a new Tacoma right now, I probably wouldn't be able to afford it, but maybe I could afford a Chevy Spark, and that's okay. To someone else who's in the same boat as me, I'd say buy a Chevy Spark now, or wait, save some more money and buy the Tacoma. But don't go out and buy a really expensive car just because car prices are more. Make sure that it's within your budget and that you can afford it.
Let's go to Alex.
Well, yeah, I definitely think it's a terrible time to have to buy a car, or either used one or new, doesn't matter. I'll just use the example of my truck. So I bought in early 2017, I bought a 2009 Dodge Ram 2500, 70,000 miles on it. It was 18.6. For a similar vehicle, similar miles, 4-wheel drive, 4-door, whatever. The price for the exact same vehicle, same age, is about double. Depending on the retailer, you may pay a little more than that, you may pay a little less than that, but used car prices are through the roof, and it's already been discussed why, harder to get at a new car, so people are buying used inventories are lower now too. So if you have no choice but to buy a car, like you've got to buy something, you're going to be paying a lot more for the same thing than you would have a few years back. So definitely a tough time to be buying a car.
I think if you're lazy, I think things got much, much more difficult in the used car market. But if you constantly keep your eyes and ears open, opportunities always pop up. It's the same with renting a room or renting some sort of a condo or townhouse. Yes, what's on the market, what's actually being advertised is extremely expensive, but what's on the off market generally is going to be as inexpensive as it always is. Yesterday I needed a ride into the car dealership to get my own vehicle serviced, and the person who gave me a ride drove me in their $900 vehicle. So that $900 vehicle was bought rather recently for the purpose of freeing up their other vehicle for Turo. So what they made in Turo last summer, the multiple of what they've made on the investment in the $900 vehicle far surpassed the cost of the $900 vehicle. The fact is that there was a $900 vehicle available for sale, and I suspect that there are thousands, if not millions, of other $900 vehicles available for sale. If somebody needs a car, there's a $900 vehicle out there somewhere for them, but you're not going to open up the Wednesday or the Saturday circular in your newspaper and find it.
Yeah. I mean, you guys said pretty much everything, but if you need to buy a car right now, then you're going to have to pay extra for it. You can look around. I mean, I'm sure there are cheap cars out there. It's hard to find, everybody's looking for that optimum ratio where the car is depreciated, has most of its depreciation out of the car, which is around 5 years. but they're also looking for something that's newer so that your repair costs are not going to start steadily increasing exponentially every year. So you're looking between, somewhere a car that's between, 5 and 10 years old is probably about the sweet spot where it's been pretty much, it's gotten most of the depreciation out of the way. And then repair costs aren't going to start increasing by a substantial amount until, 5-6 years down the road. So I imagine a lot of those cars are going to be increasingly hard to find. You can probably find something, but, if you need a car right now, that's what you're going to have to do. But if you can afford to wait, then I do it, because a lot of these, things I see, the reports from, chip makers, reports from car manufacturers are basically saying, they're probably going to see issues through 2022, but on into 2023, you'll probably see some relief from their supply chain shortages. People might be pushed into the new car market who have the money, and then that would free up some of the used cars. And possibly drop the price down a little bit. The only people that aren't hurting as much, I think, is Tesla. Because they did a pretty decent job of stockpiling some of those chips, whether there's forethought or just happened to be circumstance. But their cars are pretty pricey though, so they're not. That's probably not going to have a huge effect on the used car market. So the recent correction in the technology sector has some investors wondering if they should be selling their tech stocks. Drew, when do you think is a good idea to sell a losing stock?
I think you sell a losing stock when your strategy tells you to sell it. Unfortunately, for a lot of people, their strategy is to only buy stocks that go up and to don't buy stocks that go down. That's really not how it works. It's kind of like the famous Mike Tyson quote, everyone has a plan until they get punched in the face. As an investor, you should plan on getting punched in the face many times. If you don't, you're likely to get caught up in the emotion when the stock goes down, and you're likely to panic sell at exactly the wrong time. So have a plan for what you're going to do if an investment loses 5%, 10%, 50%, or 90%. But what would a plan like that look like? Most of the time, I'd probably tell you not to sell. When a stock goes down, it's probably still a good stock. However, things can change within a company or even a whole industry. I kind of like Warren Buffett's approach. He was all about the fundamental value of a stock. And his advice when stocks went down was to look at it and ask yourself, would I buy this stock now, even if I never owned it? And if the answer is yes, then you shouldn't sell it. And if the answer is no, you never should have bought it to begin with. There's one caveat to this, and that's if a company's fundamentals change so much that it's no longer valuable on a fundamental level. For us, we sell losing stocks based on relative strength and for tax harvesting purposes, and that's pretty much it.
Alex?
Yeah, so I think that was a pretty good explanation. I'll echo some of that. It'll really depend on what your strategy is or what your goal is with the stock. So for example, if you have a stock from the Dow Jones Industrial Average, it's paying 3 or 4% dividend interest. Even if the stock goes down, if the price is lower than when you bought it, is it still paying a dividend? Maybe you don't want to sell it, But again, it's really what is your plan with this stock? If you're going to hold it for 20 years, what does it matter what it does today or tomorrow? It matters what it does over time. In general, really, you just have to be comfortable with whatever it is you're investing. And I think Drew touched on this part too. There's a lot of people getting into day trading and whatnot who do have this attitude that, I'm going to buy something, it's going to go up, and they have no plan for what happens if it goes down or doesn't increase as much as they were planning on. So really just go in and have a plan. If you're trading to make money, know when to take a win. If you're up 20%, maybe you should sell it. Then if you're down 20%, up to your plan. The final thought I have is if it's a specific company and your shares in that company are down, if you're looking at that company and you think that the stock of that company is never going to be worth more than it is right now, probably a good time to sell it.
We do quite a few momentum strategies where we follow a company's relative strength that determines when we should buy it and when we should sell it. And I certainly have some of my own investments in those strategies. But I also enjoy owning individual stocks, and I like to buy those stocks when everybody is running away from them. Last year, during the pandemic crisis in March of 2020, I purchased some Simon Properties, which was just getting kicked in the teeth. And it's up over 100% from where I bought it at that particular time. And the dividend on my original investment is in close to double digits. And we did that for several of other clients who had the ability to invest with new money when the markets were down. And they also have had some profits as well. When it comes to selling stocks as a professional advisor, it's never difficult to get people to sell stocks when they're down. It's much, much more difficult to get clients to sell them when they're doing extremely well. And a case in point is when I first came into the industry in the 1990s, there was a stodgy utility company known as Montana Power that paid a 7.5% dividend. And most retired people in our area owned a little bit of Montana Power because the dividend was just phenomenal. Well, they married up with Touch America, and they were laying fiber optic cable during the expansion of the internet, and all of their profits were going into dividends, and the stocks doubled and tripled and quadrupled in value to the point where a lot of these small investors, 90% of their portfolios now had valuations in Touch America. And I was very, very unsuccessful in persuading people to sell. Ultimately, Touch America went completely bankrupt, and a lot of retired folks got a lot of their nest egg savings wiped out because of their inability to sell. Because when it was doing extremely well, the clients were saying, why would I sell an investment and pay capital gains tax and buy something that's not doing as well as my Touch America? And the reason why is because they were under diversified. Well, when a stock is at its high, it's not very persuasive to tell people to sell their winning investment and diversify into other things that haven't done as well in the last 3 years. But looking in the rearview mirror at decisions makes you a lot wiser. Following the rules, and to Drew and Alex's point, you want to sell stocks when the strategies you predetermined, you hit a milestone that tells you to sell. And if your stock makes up more than 10% of your overall net worth, or more than 5% of a portfolio, or whatever your strategy calls for, you want to sell that based on that those markers you're receiving.
Right. Yeah. You guys said, once again, just about everything. But the biggest thing is that you only really want to sell losing stock if something significantly, if there was some significant change in the company. And if the only change is that the stock is down, then either you didn't buy it for the right reasons, or you should probably hang on to it. I will point out is that, there's a lot of people in tech stocks right now that they're taking a beating. But I'd also like to point out, Amazon has been down like 80 to 90% a couple of times in its lifetime, particularly when it was new. Netflix, when it was still relatively new, was all over the place. I mean, that was probably I don't know if it was 2011, 2012, 2013, somewhere in there, but Netflix was probably one of the most volatile stocks of the year. And even Apple had some times when it was down, I think at least twice when it was down about 40% in its when it was still relatively new as well. So I mean, this is nothing new for especially tech stocks to be down quite a bit. I mean, stocks in general move all over the place, and if you're going to be a stock investor, I mean, this is something that you need to get used to. It's great when everyth's up 80%, but it's also, you also need to realize that it's normal for especially technology stocks to be down 80%. And that's the biggest reason why the industry as a whole is a proponent of buying index funds, because you don't have to watch them. You're not usually going to get these huge market swings because you got 100 to 500 companies in there, kind of stabilizing your average for the day. But if you own individual stocks, this is part of the game.
Well, we're talking primarily to our own clients who we advise, so they a lot of times defer to what we recommend. But for those listeners or viewers who are actually doing their own stock picking, you got to look at more than the stock price. You got to actually take a look at what the company is actually doing. If a company has a lot of debt on the books and we're going into a recession, do they have the wherewithal to make it through that recession and come out successful at the other end? A lot of times when a company's stock is going down, it's going down because the whole stock market is down and their stock prices are down is because people who have debt have to sell that stock, which is debt free, to come up with cash to pay their own bills. So that's, one person's huge loss is another person's great opportunity. One of the things I found most frustrating during the 2008 financial crisis is that the government bailed out the auto companies. I was thinking, man, this is going to be great. We're going to be able to fly right in and pick up incredible values on these companies because these morons have done everything wrong with their decisions for the companies. But there's still value in the plants. There's still value in the factories, and there's still value in the tools. We'll be able to go in and buy those things for pennies on the dollar. And unfortunately, shareholders never had that opportunity because the government came in and saved their bacon. Lots of workers and union members, got bailed out as a result of that decision. A lot of voters got bailed out because of that decision. But a lot of young people never had an opportunity to get a really good investment because that investment opportunity didn't apply to them. It wasn't available.
Right. To echo that, I think maybe a more appropriate conversation would be not to talk about when to sell a losing stock, but what to buy when stocks are down.
Right. Exactly.
I know when stocks are going down, I got excited these last few weeks. I wanted to back up the truck. I'm rifling through the sofa cushions looking for loose change just so I could put it into the market.
All right, move on to the lightning round of our show. Mars Incorporated is making changes to its candy characters as part of the new as part of its new, quotes, global commitment to creating a world where everyone feels they belong and society is inclusive. Changes to their characters include making legs and arms the same color as their candy shell, removing the stereotypical feminine attire from the green and brown M&M characters, and making the red M&M nicer. And there's a few other changes. I think the orange one accepts the fact that it now has anxiety, I guess. However, the changes have started an online debate among fans of the candy over whether the changes are a good idea or not. Drew, what do you think?
I don't really care. I guess if I did, I would find Mars to be so bigoted since the day they started to now that maybe I shouldn't have been eating their M&Ms in the first place. I don't eat a lot of M&Ms, so they can do what they want. It's not going to change the taste of an M&M to me, so whatever.
So I'll come at this from a very different angle. I was reading not long ago about there's this move in big corporate America to go ESG. We've talked about that a few times, environmental, social, and governance. And one of the big reasons why is that larger financial firms like BlackRock or JP Morgan or whoever are increasingly screening for companies in their mutual funds or ETFs or whatever that are increasingly ESG friendly. And so I'm curious if many of these companies are quote unquote going woke for little more than the reason that they want to make sure that they stay in all these mutual funds and ETFs or have access to lines of credit, things like that. I'm really curious if that's what this is really all about, and that's more important to them than making some online Trump voters angry.
Joe?
I would only care if I own Mars Incorporated stock. And if I did own Mars Incorporated stock, I probably would use that as a signal to sell, because the reality is, let's say you're sitting on the fence. I'm making a candy choice here. I'm weighing the pros and cons of which candy I'm going to buy. And now that they've decided to become more inclusive in their message and they've changed some of their little mascots to be much more asexual. I'm in with M&Ms now, whereas before I didn't really know. Now I'm for sure going to buy this candy. Compared to the millions of people who now go, I used to like M&Ms. They've become so woke, I'm not buying them anymore. if you're working on the margins for trying to get market share for your candy, I can't see how this is going to help retain or gain more market share. So I think it's a bad idea if you're in fact a shareholder of Mars.
I'm out of here.
Okay, everybody back off. I want my agent on the phone. I want Marty.
I think Alex had a good point. I think, they are probably getting a lot of pressure from BlackRock, who probably owns a pretty significant share of Mars Inc. Honestly, I looked at the picture, the before and after picture, and maybe I'll throw it up on the screen here, but I can barely tell the difference. I mean, I did not notice that their skin color had been changed to match the candy, and I would have not noticed the difference in shoes and apparel. Maybe that's just the way I am. And then I was also, a couple of years ago when I was in grad school, I was in the M&M store in New York City, and they had all their characters there, and I did not once feel excluded. Maybe it's because of who I am, but I don't know. I didn't see any difference there. All right, we'll move on to Peloton, the maker of exercise equipment that's become popular during the pandemic. Saw its share price skyrocket from its IPO price of around $25 per share all the way up to $162 per share by the end of 2020. But in 2021, its share price declined 76%, or lost 76% of its value as demand for the equipment dried up. Drew, do you think this is the end of Peloton, or what do you think is going on?
That's a great question. I don't think it's the end of Peloton. I didn't buy Peloton just for personal reasons. I don't plan on using their bikes. It's just not a product for me. I think a lot of people that bought them to begin with were doing it just for pandemic-related reasons. They couldn't go to the gym. Now that they can go to the gym, I think they're craving that gym experience again. I think Peloton certainly puts out a good product, but is it going to put out enough in the future to be profitable? I don't know. Those are my thoughts.
Alex?
Yeah, to me, Peloton stock was a bubble. You have everybody, they can't go to the gym in large parts of this country and around the world for 18 months, 12 months, whatever their lockdown situation was, wherever they are. Sales for these went through the roof. And just like their equipment sales, the stock is cratered. Everybody, in most of the time when they buy these exercise equipment and machines, they think they're going to use them a lot, and they end up using them for a little while and then not anymore. It seems to be exactly the same situation with the Peloton stock. I think it was a bubble and it's burst. I don't think Peloton is finished. I read rumors that they're being pushed by an activist investor to sell to someone like Apple or a couple other companies. So we'll see what happens to them. But to me, it's really just more regression to the mean than it is Peloton's finished.
Joe?
There are rumblings that the economy might be starting to decline a little bit. And when those rumblings happen, stocks like Peloton, you don't want to be in them. You want to be in those kind of stocks when we come out the other end, where right now there's no blood in the streets. You want to buy a Peloton after there's blood in the streets, not when there's celebrations and champagne cork busting because the economy's been doing so well. Peloton is kind of like the canary in the coal mine.
Yeah, I mean, they basically sped up, they accelerated. We kind of talked about this with Netflix too, but during the pandemic, they basically accelerated a lot of sales into one condensed period. And now you have that lull because, Peloton bikes, I mean, they're going to last you they should last you for, 5 to 10 years before you need to buy something else. They're expensive. These I think would fit into the durable goods category, and you're not going to get a lot of turnover, especially when people only bought things a year ago. Good thing they have going for them is they have like a media service, so you can subscribe and take classes and stuff online. Like I said, I don't know if it's going to be the end of Peloton. I mean, they're still trading around their IPO price, but like Alex, companies like Apple and Google who are trying to expand their health platform could look at maybe acquiring Peloton and streaming their stuff like through the bikes. But I don't know if they're looking at this when the company IPO'd a couple of years ago when it was still around $25 a share. But yeah, I've also heard rumblings that they could be a takeover target now that they're back down in that range. All right, moving on. The IRS updated its life expectancy tables for 2022. This is the first time they've done it in about 20 years. Drew, should people care?
Well, yeah, you're now going to live 2 years longer. The Oracle has spoken, and we all now get 2 extra years of life. So I think you should care about that. I'm joking, obviously. I think this really only affects anyone who turned 72 in the second half of last year. So if you turned 72 in the first half, then you would have been subject to the old RMD age of 70 and a half. So if you're one of the few that fits that category of turning 72, you just have to be careful about updating your RMD to the new life expectancy table. Your RMD will be a little bit less. If you're doing that on your own, just be mindful. Otherwise, if you work with a CPA or professionals like us, we can help you out with that as well.
Alex, do you care?
Me, not really. I don't think really anybody in our age bracket really cares at all. This doesn't really affect us. If you're a retiree or near retiree, you should probably be paying attention. Lower RMDs will probably help if you're trying to hoard that money and withdraw as little of it as possible. Beyond that, anybody really under 60 probably doesn't care. So,
Joe?
Just another example of excellent work on the federal government's part is that life expectancies are actually declining, and yet they increase the life expectancy on their tables, primarily because the kinds of people who vote are the kinds of people that don't want to pay a whole lot in RMDs. So this is certainly a investor-friendly decision, but it's not consistent with reality. We're actually seeing a decline in life expectancy.
Yeah, and it's not going to be a material difference. It is different. From what I've read, they're extremely, if you want to actually go look at them, they're extremely hard to find. You have to dig deep for them because if you look up, I think it's IRS publication, I want to say 590, I could be wrong, but if you look in there, I think they still have the 2021, or was last updated 2021. They haven't actually put the new tables up. So if you want to find them, there's a couple places online, but you have to dig pretty deep to find it because it's not well circulated at this point, but it's only going to have like a minor difference on your RMD, and it should be for the better. You should have a lower RMD for 2022. All right, last topic is that as of today, Wednesday, the 26th of this recording, the Federal Reserve just came out at the end of their 2-day conference and held a held a press conference just before the market closed, saying that they're not going to raise interest rates today, but instead are still on track to target a mid-March interest rate hike should conditions warrant. Drew, what do you think that means? Is that good news for the market? Is that bad news? What do you think that means?
It's kind of lukewarm, tepid news. The Federal Reserve is really good at just kicking the can down the road and being real vague. To quote Jerome Powell, he said, "It will soon be appropriate to raise the target range for the federal funds rate." It's like, gee, thanks, but when are you going to do it? I think investors pretty much anticipated this is what it was going to be, and that's what you get. So I don't think it's neither good nor bad. It's just kind of tepid.
Alex?
Yeah, I think at some point they are eventually going to do it because they are intent on raising rates at some point. I think, though, that both businesses and investors are throwing temper tantrums right now, and they're letting the Fed know that they really do not like this. I'm not sure if the Fed is going to do more than one or two. We'll find out. But like the press conference said, like Drew already mentioned, they're already building in the ability for them to back off of this completely or in a major way already. So I'm really wondering if they're just going to do it because they have to do it because they keep saying they're going to do it. Beyond that, I'm not surprised they're leaving rates as they are right now.
Joe.
This is the Fed yelling upstairs saying, economy, if you don't slow down inflation, I'm coming upstairs. I'm counting to 3. 1, 2, 2.25, 2.5, 2. They're basically stalling.
I think it's possible, is all I would say.
The only difference is that inevitably they're going to have to do something, or the market will go into a recession on its own, and then the demand will go down to meet the low supply. Something's got to give. Either the Fed makes a decision or the economy makes a decision, but we cannot have Fed inaction and runaway inflation at the same time. So I wish they would have just pulled the Band-Aid off. We could have just eaten a rate hike in the January meeting. It's not going to happen. We have no control over those decisions. We just adjust to whatever the market or whatever the Fed and the markets decide to give us.
Yeah, typical Fed statement. They said we might do it and left a lot of room to change their mind. So we'll probably just cross this bridge again in March. They've done this before. Especially if things are looking really bad. It's not unlike the Fed to just punt another 3 months or something like that to their next meeting. But typical Fed comment. Again, telescoping that we're probably going to do it, but kind of wishy-washy or whether mid-March will actually be the actual date or not. So.
Yeah.
All right.
We'll see.
Was that?
We'll see, I suppose. I'm just really curious because they keep coming up with mixed messaging about what's causing the inflation. As far as I can see, it's really supply chain first, and I'm not sure raising rates is going to do much of anything other than cause problems for businesses and consumers. It's not going to do anything to resolve the supply chain issue. In order to do that, we have to get back to producing, food and electronics and everything else to the same capacity as we were pre-COVID. Otherwise, you're still going to have demand that outstrips supply. And if their only goal is to destroy demand by putting people out of work or making it more expensive for businesses to start or expand or anything else, I can't see how that's going to be helpful to the economy. But I think they're intent on raising these rates to some extent. We'll see if they actually do.
That's a good point. When you think, inflation is primarily caused by supply chain issues. Yeah, it's hard to know what rate rise is going to do. It's hard to know how much of the inflation is caused by supply chain, and just by printing money. So love to see. But that'll be the end of that's probably our longest lightning round to date. But that is it for episode 27, and we'll see you next week.